What if you could save over $200,000 in taxes in retirement? Today, we're diving into a topic that could save you thousands, if not hundreds of thousands of dollars in the future. We're talking about 3 missed opportunities to reduce taxes in retirement that many overlook. Retirement planning is a marathon, not a sprint. And the tax implications of your savings and withdrawal strategies can have a massive impact on your golden years. Whether you're nearing retirement or are planning ahead, understanding these missed opportunities can make all the difference. From overlooked tax credits to investment strategies that could lower your tax bill, we got you covered. So are you ready to find out how you can keep more of your hard-earned money in your pocket and out of Uncle Sam's? Stick around to the end and we'll run through an example of how applying these techniques can have a big impact on your retirement. If we haven't met yet, I'm Josh Leonard, President and Financial Advisor at the Leonard Advisory Group, where we help those nearing retirement transition into retirement with intent. I'm also the host of the Relax It's Retirement podcast and host various monthly lunch webinars on topics ranging from retirement taxes to Social Security claiming strategies. Make sure you hit the like button, subscribe, and ring the bell to stay updated on our latest content designed to help you retire with intent. Starting off, we have tax gain harvesting. Tax gain harvesting is a financial strategy that involves intentionally selling investments at a profit in order to realize capital gains. This might sound counterintuitive at first. After all, why would you want to pay taxes on gains sooner rather than later? However, when executed properly, tax gain harvesting can be a powerful tool in managing your overall tax liability and enhancing your financial situation over the long term. Let's delve into the nuances of this strategy. The idea behind tax gain harvesting is to take advantage of lower tax rates on capital gains in certain situations or to reset the cost basis of an investment. Here are the key concepts. Capital gains tax rates. Long-term capital gains on assets held for more than a year are taxed at a lower rate than short-term gains. For some taxpayers, particularly those in lower income tax brackets, the long-term capital gains rate can be 0. Resetting cost basis. By selling an investment that is appreciated and then repurchasing it, you can increase the cost basis of the investment. This means if you sell the investment in the future, the taxable gain may be lower since it's calculated based on the difference between your selling price and the new higher cost basis. Tax gain harvesting can be especially beneficial in the following scenarios. In low income years, if you find yourself in a particularly low tax bracket in a given year, perhaps due to retirement, a sabbatical, or temporary job loss, harvesting gains may allow you to pay little to no taxes on those gains. If you expect to be in a higher tax bracket in the future or anticipate tax rate increases, realizing gains now could result in lower taxes compared to waiting. Offsetting with losses. If you also have investments that have lost value, you can use a strategy known as tax loss harvesting to offset the gains you've realized through gain harvesting, potentially reducing your tax liability further. Other considerations and risk, we must be aware of the wash sale rule. While the wash sale rule does not apply to gains, it's critical when selling investments at a loss not to violate this rule by repurchasing the same or a similar asset within 30 days before or after the sale. Market risk. Selling and repurchasing investments exposes you to market risk. The market could rise during the period between selling and repurchasing, maybe leading to a higher overall cost. Consider transaction costs and fees associated with selling and repurchasing investments, as these can get into the benefits of tax gain harvesting. Tax gain harvesting is a nuanced strategy that requires a deep understanding of your own tax situation and careful consideration of the broader market conditions. It's often used in conjunction with other tax planning strategies to optimize an individual's financial picture over time. As with any tax strategy, it's important to consult with your financial advisor or tax professional before implementing these strategies. Next up, we have Roth conversion tax bracket maximization. Roth conversions are a powerful strategy in retirement planning, allowing taxpayers to optimize their financial situation for the future. This involves converting money from a tax-deferred retirement account, like a traditional IRA, into a Roth IRA, where withdrawals in retirement are tax-free. The key to maximizing the benefits of Roth conversions lies in understanding and leveraging tax brackets effectively. Let's explore how this works and the considerations involved. Understanding Roth conversions. When you convert funds from a traditional IRA to a Roth IRA, the amount converted is added to your taxable income for that year. This means you pay income taxes on the converted amount at your current tax rate. However, once the funds are in a Roth IRA, they grow tax-free, and withdrawals in retirement are also tax-free as long as you follow the rules. Maximizing your tax brackets. Strategic timing of Roth conversions can help you manage your tax brackets more effectively, both now and in the future. If you have years where your income is unusually low, converting during these years can be advantageous. You'll pay taxes on the conversions at a lower rate than you might be in the future, especially if you anticipate being in a higher tax bracket in retirement. Another strategy we use is filling up your current tax bracket. You can convert just enough to fill up your current tax bracket without pushing yourself into a higher bracket. This strategy allows you to gradually move money into a Roth IRA while managing your annual tax liability. Avoiding higher future taxes. If you expect tax rates to increase in the future or believe you'll be in a higher tax bracket in retirement, maybe due to required minimum distributions, converting to a Roth can lock in the current lower tax rates on the converted amount. Some other considerations and strategies. Tax diversification. Roth conversions can provide tax diversification. By having both tax-deferred and tax-free accounts, you can better manage taxes in retirement. You can choose which accounts to withdraw from based on your tax situation that year. RMD considerations. Traditional IRAs and other tax-deferred retirement accounts require minimum distributions starting at a certain age, which can increase your taxable income in retirement. Converting to a Roth IRA can help manage or eliminate RMDs, as Roth IRAs do not have RMDs during the owner's lifetime. Estate planning. Roth IRAs can be a valuable estate planning tool, providing tax-free growth and withdrawals for your beneficiaries. However, beneficiaries, except spouses, are required to withdraw the entire account within 10 years under current laws. Timing and market considerations. The timing of conversions can impact your tax and investment strategy. Some prefer to convert during market downturns when the value of their investments is lower, thus reducing the taxable amount of the conversion and potentially reaping a greater tax-free growth as the market recovers. Summing up, Roth conversions offer a strategic way to manage taxes, but they do require careful planning and considerations of your overall tax situation, both now and in the future. Like any strategy, make sure to consult with your financial advisor or tax professional before implementing. Qualified charitable distributions offer a tax-efficient way for retirees to support charitable organizations while potentially benefiting their financial and tax situation. A QCD allows individuals age 70 and a half or older to donate up to $105,000 direct from their IRA to a qualified charity each year without distribution being included in their taxable income. Here's how QCDs work and why they can be particularly beneficial for those that are retired. You must be 70 and a half years old or older to make a qualified charitable distribution from your IRA. The distribution must go directly from the IRA to the qualified charity. This means the IRA trustee or custodian makes the payment direct to the charitable organization. Each IRA owner can donate up to $105,000 per year as a QCD. If you're married and your spouse also has an IRA, they can contribute up to $105,000 from their IRA as well. The amount donated as a QCD is excluded from your taxable income. This differs from a regular charitable contribution deduction, which only reduces taxable income if you itemize deductions on your return. Most charitable organizations that are eligible to receive tax deductible contributions meet the criteria for QCDs, but there are exceptions such as donor advised funds and private foundations. The big benefit for retirees is lower taxable income. Because QCDs are excluded from your taxable income, they can lower your overall tax liability. This can be particularly advantageous for retirees who do not need their required minimum distributions for living expenses and would otherwise just be taxed on that money. If you're not already taking an RMD, it'll most likely start at age 73. When those required minimum distributions begin, they're generally taxable. A QCD can work to satisfy your RMD for a year, up to $105,000, without increasing your taxable income. This can be strategic to manage your RMDs, especially if you're charitably inclined. Another way that this could help is by potentially reducing your Medicare premiums. By reducing your taxable income, QCDs may also help lower your medical Part B and Part D premiums, which are based on your income level. If you're a non-itemizer, this is a great strategy for you. With the increase in the standard deduction, many retirees find it beneficial to take the standard deduction rather than itemizing. QCDs provide a way to receive tax benefits for charitable contributions without having to itemize. Using QCDs as part of your charitable giving strategy can also be an effective estate planning tool, helping to reduce the size of your taxable estate while supporting the causes you care about. Considerations for QCDs? The biggest one is documentation. It's important to keep good records of your QCDs, including documentation from the charity acknowledging the donation and confirming that it's a qualified organization. Coordination with other IRA withdrawals. If you take other distributions from your IRA before executing a QCD, those distributions may count towards your RMD for the year, potentially limiting the effectiveness of the QCD to satisfy your RMD requirement. In conclusion, qualified charitable distributions offer a tax-savvy way for retirees to make charitable donations directly from their IRAs. By leveraging QCDs, retirees can potentially lower their taxable income, satisfy their RMD requirements in a tax-efficient manner, and support their favorite charities. As with any tax-related strategy, make sure to consult with your financial advisor or tax professional to make sure it fits in your overall strategy. Now that we've covered the 3 missed opportunities to reduce taxes in retirement, I wanted to put things in perspective. Saving money in taxes is important, but for most folks we meet with, having more money net of taxes is even more important. Retirement planning is a puzzle, but working with a financial advisor can help you clarify your goals to make sure you're solving for the right thing. After all, saving money in taxes is good, but running out of money in retirement is awful. Let's run through a case study to see how these strategies can save over $200,000 for our sample clients. First up, let's review capital gains tax brackets. As I mentioned earlier in the video, capital gains for qualified funds can be either 0, 15, or 20%. If you're married filing joint in 2024, capital gains for any income up to $94,050 is taxed at 0%, or those gains aren't taxed. From $94,051 up to $583,750, they're taxed at 15%. Commonly, we hear capital gains are taxed at 15%, and with such a wide bracket, that's why we often think that way. Anything above that limit is taxed at 20%. Now, if you file single, those limits are a little bit lower. We stay out of the capital gains up to $47,025, and then the big wide range for 15% then goes up to $518,000. Anything above that is taxed at 20%. Looking at our sample case, we have Bill and Cindy's sample. Now they're both in retirement and they're looking to generate income in retirement. At this point, Only one of them is claiming Social Security, so they have about $24,000 in Social Security benefits. As we've talked about in previous videos, one common strategy is for one spouse to take their retirement benefit from Social Security prior to age 70 and allow the higher income earner to defer to age 70. That's what Bill and Cindy are doing in this case. But they need a little bit more in income. So they're also withdrawing $86,000 from their IRA to cover their income needs. For Bill and Cindy, if they instead decided to realize some capital gains and take a smaller withdrawal from their IRA, they could fill up their tax brackets. In this scenario, they'd be taking $11,000 as a withdrawal from their IRA and have a capital gain of about $75,000. This is the worst case scenario. Keep in mind these capital gains are only on the appreciation. So if you bought a stock for $50 and then later sold it for $100, your gain would not be $100, it would only be $50. So this is an extreme example. This assumes that they had pretty much no cost basis or they got the stock for free. In this scenario though, although they have adjusted gross income of $106,400, after their standard deduction, they would actually pay $0 in taxes. This is a great way to minimize taxes. One common issue that we see though is not looking at the long-term impact. So while this might erase any tax liability for the year, it might cause a problem down the line when they have to take RMDs. By not taking withdrawals from their IRAs early in retirement, we continue to grow those IRA assets. In the future, once RMDs kick in, they might be forced to take out more than they need and be pushed into a higher tax bracket. So let's jump in to a full plan. Providing some more details on Bill and Cindy, they're both age 67. They do have 2 kids. They retired at age 62, but they expect to live a long time. In terms of their net worth, they have a healthy emergency fund with about $35,000. They have their taxable investment account where they can sell off stocks to have those capital gains income that we talked about before. Bill also has a retirement account with about $400,000 in it. So does Cindy, and they have 2 small Roth IRAs, as well as their primary residence, valued at about $430,000. Income, as we mentioned, they have $24,000 now coming in from Social Security. In terms of expenses, they need about $100,000 a year after taxes. When we build out a plan for them, our default would be to start withdrawing from all taxable assets right away. If we look at that scenario, they're in pretty good shape. However, if we look at the tax liability, we could see over their lifetime, assuming they live to age 100, they would pay cumulative taxes of about $443,820. That's a pretty big tax bill. If we look to implement some of the strategies we discussed, like spending some of those capital gains early in retirement, we can reduce taxes in retirement. In this scenario, we reduced taxes by $55,000 in this scenario. However, their portfolio assets also declined by the end of their lifetime by about $852,000. Again, this is why the long term and the net of taxes becomes more important. If we look to add things in like Roth conversions, that QCD strategy that we talked about, in their case for Bill and Cindy, they typically contribute about 10% of their income or $10,000 a year to charity. So just by making those QCDs or those qualified charitable distributions after age 70, they save about $19,000 in taxes. If we pair that up with maximizing Roth conversions prior to age 73 to fill up the 12% tax bracket, we reduce taxes by $19,000. We adjust living expenses to offset for the QCD and optimize a withdrawal strategy between pulling out of the capital gains and pulling out of their IRAs. It gets them about $2.9 million more in lifetime assets while reducing taxes by $214,000. Now that's a big impact over time. This would set them up in a better situation for their estate as well, as we would have a lower tax liability for those inheriting the accounts as well. And there you have it. Insights into strategies that could significantly impact your retirement savings and reduce your tax liabilities. From understanding the nuances of Roth conversions to leveraging tax gain harvesting and not forgetting about those strategic QCDs, we've covered the ground on tactics that could save you thousands or hundreds of thousands throughout retirement. Remember, planning for retirement isn't just about saving. It's about smart saving. It's about making your money work for you in the most efficient way possible, minimizing taxes and maximizing what you can enjoy during your golden years. We hope today's episode empowers you with the knowledge to make informed decisions about your retirement planning and tax saving strategies. Your future self will thank you for the effort you put in today. If you found value in today's video, please give us a thumbs up, share it with friends and family, and subscribe to our channel to help retire with intent. Don't forget to hit the bell icon so you never miss an update from us. Your journey to a tax-efficient retirement starts with a single step, and we're here to guide you every step along the way.